Hello, my name is Ilaria Maselli, and it's a pleasure to welcome you to this edition of Off the Shelf, a book discussion series brought to you by the Conference Board. Today, I will be sitting down with Bluford Putnam to discuss his latest book, Economics Gone Astray. Blue is the Chief Economist and Managing Director of CME Group, the operator of futures and options exchanges. The book is made of 16 chapters in which Blue, Eric Norland, and Katie Arazu provide practical explanations for some of the key macroeconomic topics of the day, with the underlying assumption that economic thinking has gone astray. You mentioned three reasons for that, Blue. One, most economists continue to ignore or dismiss behavioral effects in their models and theories. Two, they also continue to ignore institutional, political, and the demographic environment. And three, they use mathematics inappropriately. On this latter issue, you write in the introduction, when we read the classical economists who wrote before the extreme mathematization of economics after the 50s, we are often struck by the elegance and the clarity of their thinking. Along the same lines, you argue later in the book that machine learning models cannot be used without the expert eye of someone that knows, for instance, when a structure or policy change happened. You can imagine why I was intrigued by the book after this premise. I didn't read the book following the numerical orders of chapters. I started with demographics. You argue there against mainstream thinking that the economy in Japan is actually doing quite well. Blue, can you explain why?
Yes. The interesting thing about Japan is it had a very rapid growth of its labor force in the 1950s and 60s, and then it started to slow down a little in the 1970s and 80s, and it came to an abrupt halt in the 1990s. And so this is the reason that demographics are so important. Back in the 50s and 60s, what was happening in Japan is they were moving people from the farm to the city, and they were gaining productivity and growing very rapidly as a country. By the 1990s, they had aged, and their labor force stopped growing at all. Now, so those are really different demographic patterns, from growing fast labor force to not growing at all. Now, think about how you calculate real GDP. The arithmetic is that real GDP is the addition of two things. You have the growth of the labor force and the growth of labor productivity. So if your growth of your labor force goes from very fast to moderate to zero, your economy in real GDP growth terms is going to slow down. And a lot of people looked at Japan in the 1990s and 2000s, and they said it's the lost decade. But what it really was Japan had to cope with the fact that its labor force was no longer growing at all, and the population was aging. And I think they did an exceptionally good job of that. They've continued to modernize. If you went to Japan in the 1990s, as I did, and you go back today, it is a totally modern country. It hasn't lost any of its edge in technology. So they've been growing along with the rest of the world. It's just real GDP looks slow because you're comparing it to countries with labor force growth. And by the way, the United States in the 2020s and 2030s isn't going to have much labor force growth, so the U.S. is going to grow slower too in GDP terms, but it's not a bad thing. It's just a natural thing of your population not growing as fast.
Interesting point, Blue. And as you were talking, I started thinking about China. And given the long-term consequences of the one-child policy, growth in China is also meant to slow down, right? Is the economy worth for that?
Yes, China's an interesting parallel here because China doesn't have much labor force growth overall already. It has a little bit, but not very much. But it still has a huge migration of people from rural areas to urban areas. It's about 15 million people a year, one New York City a year. And that adds 2 to 3% to their GDP growth every year. Now that migration is going to run out in the 2020s. And as that migration runs out, they're also hit a period where their population has aged, and because of the one-child policy. Now, they've gotten rid of the one-child policy, but the lagged effects is that their labor force isn't going to be growing, so they're going to slow down. And you might say, well, wait a minute, they did get rid of the one-child policy. But I'll tell you, I talked to my doctor about this. It takes 30 years to make a 30-year-old, and it's not going to impact the labor force until the 2040s and 50s that they've changed that policy. So China's definitely going to have slower real GDP, slower growth rates in the 2020s, more like 3 to 4% instead of the 6% they record now.
And well, Europe is also in the same situation. So Japan, US, later, a little bit later, China. Is the world economy ready for that?
I think the world economy is. The world economy has adapted fairly well. The politicians have not. The politicians still want to promise growth rates of the past, and they just don't get it, that those are not achievable growth rates. So we're probably going to see some interesting policy mistakes as the world leaders in these older countries try to do things that their economy is not capable of doing. But the companies have already adapted.
So speaking of policy mistakes, let's move to monetary policy. In the last part of the book, you have a rather severe judgment of monetary policy after the global financial crisis. In particular, you argue at some point that quantitative easing did not succeed in rising inflation and stimulating growth. Can you explain that?
Yes, quantitative easing is the purchase of assets by the central bank. And the Federal Reserve introduced quantitative easing in the fourth quarter of 2008. As you may remember, there had been this very messy bankruptcy of Lehman Brothers and a bailout of AIG, and the Federal Reserve had a hand in that, and they just didn't do a very good job. But immediately after realizing that there were severe problems in the economy and in the financial sector, the Federal Reserve bought about $1 trillion of assets. Now, the assets that they bought at that time were very distressed assets. They weren't Treasury securities, they weren't mortgage backs, they were distressed assets. And that really helped the U.S. economy recover. So that part of the quantitative easing was good. But by 2010, 2011, the U.S. Federal Reserve was not happy with the growth rate of the economy, and it wanted it to grow faster. It wanted to see more inflation. So they put in asset purchases of U.S. Treasuries and mortgage securities at a time when the economy was already growing. And what happened was that asset prices responded. Bond prices rose, bond yields fell. The equity market responded with less volatility because bonds were giving it a comfort zone, and the Fed had the equity markets back. And so all of the impact of quantitative easing went into asset prices, but it didn't go into bank lending because banks were already constrained by not having enough capital. They had reached their capital limits. So whatever the Fed bought wasn't going to change bank lending, and so it didn't change business and consumer spending, and so it had zero impact on inflation or economic growth. And the Fed should have known that, but they were desperate to try to get to a growth rate that the economy couldn't achieve, and so they were just trying new things, and it didn't work.
And I wonder if there is another aspect that is another impact of the QE that is underestimated, and that's the impact on inequality. Do you think that played a role?
Well, we do know that the wealthiest part of any population is the part of the population that owns equities and owns bonds. Typically, if you're in the lower income segment, you don't have a portfolio, or you certainly don't have a large one. And so when you adopt a policy that stimulates asset prices, you are automatically going to benefit the wealthier class more than the poorer classes. So yes, the Federal Reserve definitely contributed to the wealth divide. That wasn't their intention, by the way. It was an unintended consequence. But again, they should have figured it out.
Very interesting. We're going to take a short break for some quick announcements and be back in just a minute to continue this fascinating conversation with Bluford Putnam on the book Economics Gone Astray.
Looking for additional insights beyond this podcast? The Conference Board hosts an array of annual seminars and conferences on a wide selection of topics that impact your business. Learn best practices from top companies and hear insights from renowned practitioners and thought leaders, all while having the opportunity to network and collaborate with your peers. For a complete list of our upcoming programs, you can visit us at www.conferenceboard.org/events. And as an added thank you for listening to this program, use code POD300 to save $300 off your registration. That's POD 300. Seats fill up quickly, so visit our website and reserve your spot today.
Hello and welcome back to our conversation with Bluford Putnam on the book Economics Gone Astray. Let's continue for a moment on monetary policy before moving to the chapter dedicated to Bitcoin. At the end of the day, Blue, what is in your view the key difference between the European Central Bank and the Fed?
The European Central Bank and the Fed reacted very differently to the crisis in 2008. The reaction of the Fed, as I mentioned before, was to buy distressed assets. And they bought $1 trillion of those assets, and they took them out of the financial system so that the U.S. banks tended to recover fairly quickly from the financial panic. The European Central Bank took a very different approach back there in 2008. They decided to lend money. So they made emergency liquidity loans to their banking sector by, again, €1 trillion. And what that did is it prevented any kind of problems for the banks, but the banks still in Europe had all the bad loans and all the distressed securities. So even though they had no problem remaining solvent, they weren't very profitable, and they had almost like a good bank and a bad bank, and they were never able to get out of their troubles very quickly. And so the European Central Bank method of relying on emergency liquidity loans stabilized the system, but it did not allow it to recover very fast, and it didn't allow lending to good prospects and so forth to resume. And so the European recovery was much, much slower than the U.S. recovery. Now the European Central Bank has changed direction on that. In 2015, they started looking at quantitative easing, and they have even in the last year or two become a little more available to even buying other types of debt that have helped the banking system. But I think we're going to see a further change once the European Central Bank gets a new president, which will happen in October. Then they can move forward with a little bit more of a proactive program to help European banks get rid of their bad assets and grow a little faster, because that's really what the system needs.
So basically, the ECB started quantitative easing much later than the Federal Reserve, and yet your judgment of the operations is not so much better.
Yes. Economists are a little bit sloppy on a lot of definitions, and some people define quantitative easing as an expansion of the balance sheet. And under that definition, loans would count. So the ECB was actually involved in quantitative easing because it was expanding its balance sheet through loans. But I use the more stricter definition of asset purchases. And asset purchases at the ECB really didn't take off until 2015, much, much later in the game. And by the way, they haven't worked there to stimulate inflation or economic growth either, but they have dramatically lowered the prices of, raised the prices of bonds, and they've taken the interest rate on things like the German bond to zero, and that's probably not healthy either.
Right. Do you think we're going to see inflation coming close to 2% anytime soon on my side of the world, here in Europe?
Inflation is 1%, 1.5%. It's bouncing around. I'm not a good enough economist to make a difference between 1.5 and 2, but I do think I don't see inflation rising above 2% in Europe anytime soon. I think the demographic pressures are keeping inflation low. Global competition keeps inflation low. The internet, where you can comparison shop, keeps inflation low. So there are just a lot of forces outside of the control of central banks, and I think inflation is likely to stay fairly low. So more closer to 1% than 2%, but we're fine-tuning outside of my expertise here.
Right, but it's interesting that you go back actually to where we started, which is demographics, and it looks like not only economic thinking but also economic policy is not adapting to that. It's not getting any new tool to deal with the large consequences of the demographic pressure on the economy.
Yes, demographic pressure tilts the pendulum more toward fiscal policy and away from monetary policy. And, in Europe in particular, there's been an insistence on staying with very austere policies. And so, we'll see if that changes over the next 4 or 5 years.
We will see. Now, I'm moving to Bitcoin. In the chapter, you dig into the demand and supply of the cryptocurrency, and I found the analysis as simple as insightful. Your point there is that there are many similarities between the supply of Bitcoins and the supply of energy commodities. Can you elaborate a little bit on that?
Yes, one of the interesting things about Bitcoin is the supply is very tightly controlled by the formulas that underlie Bitcoin mining. And so the supply isn't quite fixed. It's growing very, very slowly, but it will be fixed after around 2040, 2042. And so you have a commodity in which supply can't really respond. It's going to be either growing very slowly or not at all. And that means that when demand changes, you get a much bigger impact on prices than you would with some other type of commodity in which supply can respond. And so one of the things that we looked in that chapter of the book is we looked at natural gas. Natural gas is a commodity which you can get supply responses to price changes, but they happen very, very slowly. So for instance, if you have exceptionally cold weather, people are going to use more natural gas to heat their homes and so forth, and the natural gas price is going to respond very rapidly upward. And so we use this comparison to try to look at commodities like natural gas that were supply constrained. And then when you have a demand shift, you get a big price move up or down depending on which way demand shifts. And Bitcoin responds a lot like that because its supply not quite fixed, but almost fixed.
Deeper in the book, and then you say, well, at the end, when it comes to gas, the supply is fixed in the short term, but then the production can adjust in the long term. But at the end of the day, also when it comes to Bitcoins, is a bit the same because there are some untapped resources. So for example, it's been said that the owners own a certain quantity of Bitcoins that they can sell, and then the supply would change as well. So I found that parallel also very intriguing.
Yes, that's true. A large part of the Bitcoin wealth is owned by not a lot of people that were involved early on in the Bitcoin movement. And so if they decide to, if you will, switch from Bitcoin to traditional securities, then that selling pressure would drive the price down quite rapidly. Then if they stop, the price can bounce back up. So yes, that is an additional supply. And the commodity that compares to that is gold. All of the gold mined since the beginning of time is still pretty much with us. Central banks have a lot of it, but if central banks were sellers of gold, they could move the price, although they almost never do that. They're pretty much buyers. So yes, there are interesting commodity parallels with Bitcoin.
And what about the demand? Because the supply of Bitcoins is a little bit more known, the mechanism, but when it comes to the demand, it's very difficult to understand what happens every month.
Yes, if you read our chapter carefully, it's pretty clear we don't understand the demand side either.
But you find something interesting on the cost of the transactions. I found that a fantastic intuition.
Oh, yes. There's still mining of Bitcoin going on, and the mining depends heavily on electricity because you do the mining through computer algorithms and you need these big server farms. And so the mining has migrated to places around the world that offer cheap electricity. Iceland, Mongolia, some parts of China where the hydroelectric power is cheaper. But as the cost of electricity rises, it does impose a cost on the mining. So it does have an impact on Bitcoin pricing.
I will keep that in mind. Now, let's go back to the real economy. Most economists agree that wage growth should by now be stronger than what we actually observe in the US and also in the euro area. And this is definitely a puzzle because the economy has been strong, unemployment is very low, especially in the US, of course, and yet aggregate wage growth is not increasing along. Blue, do you have an explanation for this?
Well, the type of theories that suggest we should be having more wage growth come out of the labor economics that was developed in the 1970s and early 80s. And that was a very, very different period. That was a highly inflationary period in the 1970s. And so you did have wage growth responding to the inflation, and it responded also when conditions of unemployment got tight. But, now we're in a very different situation. The fastest growing sectors in the economy, particularly the ones that create jobs, are largely lower paying service jobs, particularly like in the United States, where the retail sectors or the leisure sectors, these are service sectors. And so you're expanding jobs that don't pay as much. And so you have to remember that labor costs as produced by the people that produce the statistics, these are averages of all jobs, and if the lower paying jobs are expanding faster than the higher paying jobs, the average isn't going to grow as fast. So people just aren't paying attention to how the wage growth is developing underneath the surface. They're just looking at averages. Averages is probably the statistic I hate the most. Your head's in the freezer, your feet are in the oven, and you feel fine. I don't think so.
That's a fantastic explanation. And it's interesting because we're going back to another thing that came before in the discussion on monetary policy, and that's inequality. So again, the distribution matters, and it matters again for wage growth. You're based in the US, where President Trump enacted a major reform of corporate tax. And your judgment of that is quite severe. And against the common intuition, you argue that tax cuts do not generate economic growth. How is that possible?
Well, back in my early days as an economist, I became friends with Art Laffer, who is the genius behind supply-side economics and so forth. And the theory that Art Laffer and others developed was that if you lower marginal taxes, you will increase economic growth. And it's all based on the impact of these marginal taxes, based on what the tax rate is. One of the things that theory assumes is that there are no loopholes. And of course, that's the assumption that matters so much because the loopholes dominate the marginal tax. If you reduce the marginal tax rate but keep all the loopholes, you're not going to change behavior. And so that's what happened, is that we cut the marginal tax rates, we gave corporations a nice tax cut, but the loopholes were still there. And because the loopholes weren't closed, it had very little impact on economic growth. It did have an impact during the first quarter and a little bit in the second quarter of 2018, but it's all dissipated now. And the only real impact that's left is massive trillion-dollar budget deficits.
And how will that have an impact on growth in the U.S.?
Well, the U.S. government or any government running bigger deficits is not necessarily indicative of that there'll be a recession or there'll be a problem right away. You're passing the costs on and the problem to the next generation. So the more debt an economy has, and it can be public or private debt, it makes the economy more fragile. It makes the economy more vulnerable to increases in interest rates. So it increases the possibility of a recession if their interest rate increases. But it doesn't mean there's going to be one, and the costs typically are paid by the next generation. So we've passed the baton again.
After all this heavy lift and tough questions, I want to ask you a personal one. Which book had most influence on your economic thinking and why?
Well, more recently, I've been reading older books. And we're in a trade war, an economic war, and back after World War I, there was a period in which we also were into some kind of an economic warfare. So I went back and read John Maynard Keynes's book, Consequences of the Peace. And it's a book about the peace treaty that ended World War I and set the terms and conditions for reparations by Germany and so forth. And John Maynard Keynes was at the peace treaty. He was a member of the British Treasury at the time, and he wrote this very interesting, it's a very short book, and even better, you only have to read the first 35 pages. You can forget the rest of the book. But he describes each of the players at the peace treaty, the U.S., the French, the Germans, the Italians. He describes the personalities, he describes the economies, and he goes back and looks at the demographics that shaped Europe in the 1880s and 1900s, and it's just a fascinating look at what caused or what helped to create World War I, and then how the French and the winners of World War I imposed such strict conditions on Germany. And John Maynard Keynes' conclusion was these conditions are so strict you're going to cause another war. And he got that forecast right, unfortunately. So it's just a fascinating book, and it has a lot of interesting descriptions of current countries and so forth. And by the way, that's the book that made John Maynard Keynes famous. It got him his professorship at Cambridge, and he was quite young at the time that he wrote it.
Wow. Commercial moment to conclude this conversation. Blue, where do I go if I want to buy your book?
The easiest place to go is, of course, the internet and Amazon, but it's published by the World Scientific Press, and you can go directly to them as well.
All right. Thank you, Blue, and thank you all for joining this podcast. Remember to subscribe to our Off the Shelf channel to hear more book discussions. All our podcasts are available on conferenceboard.org/podcast or any platform like iTunes, Google Play, and Spotify. If you'd like to hear more on economic-related topics, we also invite you to subscribe to the Conference Board Indications podcast channel. I myself will be hosting a podcast in July 2019 where I share the new data from our Global Consumer Confidence Index. I'm Ilaria Maselli from the Conference Board, and thank you all for joining us.